Okay, we'll get started here. It was a cool round last round. I don't like that. It was kind of people moving all kinds of different directions. You can see that just by the change in the stock prices. You know, we got some, these three pretty level, but boy, it just kind of little movement down there. Old Digby, look at that, down, up, down. Be interesting to see if they can make another rebound this next round to head it back up. So we'll see. Let's take a look first at the assignment for Chapter 2. First question was, Ebb had the lowest material cost in the low-end segment. How or why? Did that fact adversely affect Ebb's sales? And my question here, I'm trying to guide you a little bit. The main reason they had the lowest MTBF was because the lowest material cost was because of their MTBF. If you look in the low end, they've lowered their MTBF to 12,000 or 1,200, whatever it is. That's the lowest you can put it at, right? Okay. What product in the low end also sold the most? I want to think it was Ebb. Okay, so did it adversely affect its sales or its age too? Its age was actually pretty close to the ideal, if I remember right. Okay, or one of the closest to the ideal, so that was a plus. But it didn't, right? Okay, not only did Ebb have the high sales, it had the highest potential, right? And so, again, you guys, I think I want to keep trying to push this. There's that customer buying criteria, and I'm not sure that every team is paying as close attention to that as you ought to, okay? I mean, it ranks it. It tells you the percentage that the customers are interested. Ebb, which is one of the computer teams, has obviously figured out that MTBF isn't a big deal for the low-end folks, right? And, oh, by the way, we can save some money on material costs by lowering our MTBF in that category, and it's not going to adversely affect our sales because it's the fourth thing on the list, and it's only like 7% or something, right? I don't know if you guys have it opened up in front of you, but it's something to that effect, right? Okay. What's the total industry production capacity in the high-end segment for the next round? A lot of people got the MTBF, and a few added the oldest product, so that was pretty good. The Part B, I think the answers were a little. Okay, what's the total industry production capacity in the high-end segment for the next round? In other words, how many units can all 6 teams make in that segment? Many of you forgot the second part of this, and that is that we can make double our first shift capacity. All right, so a lot of you did the math and did it okay. You came up with 3,600 or 3,601, which is the correct number. I probably didn't mark you wrong if you had 3,600, but you got to take it times 2, right? Because our first shift capacity is 3,600, but we can make 7,200. It's kind of why I added the second part of that question, so everybody hopefully do the extra math. So, okay, what will be the total industry demand in the performance segment for next round? Folks did pretty good on this one, I think, for the most part. I just want, this is a good lesson. I will tell you that doing this math from here on out, okay, maybe for each and every segment might produce some, might allow you to find some opportunities, okay? It doesn't always happen. That's not every game that I've seen played. But doing this math can create some opportunity. It doesn't create the opportunities, but it will demonstrate to you some opportunities that might be available. Okay. So I put that on there. Get you guys thinking about that, right? Look at and in fact it kind of goes with the second question. Okay. You got total industry capacity. You got total industry demand in each segment, right? 4. Why did Bead sell out in the low end segment? It wasn't the best product, I don't think. Okay. In fact, it had pretty low potential, but it simply because other teams, especially Ferris, didn't produce enough. Okay, bead was not popular at all. If I'm not mistaken, bead's got their price right at the very high end, which is the #1 factor. Am I right about that? You guys have that? Yeah, so they're at the very high end. They should have pretty good contribution margin. But if the other teams would have gotten busy, boy, they would have really been shortchanged in the sales department. That might have happened to them in round 3. We'll take a look here in a bit and see. So, okay, why was Bede's potential so low? You know, you just go right down the list, right? Its price was too high. Its age was not near the ideal. It wasn't placed very well. Promo and sales, that doesn't occur up in the customer buying criteria, but that was one. MTBF would have actually kind of been a plus for it, but again, MTBF it's the last thing on the list. It really was not that important. As we can see, they had the highest MTBF, but their potential was still low. So, okay, so the computer or the customers didn't really care about MTBF, okay, but they cared about price. And in Bede's case, their potential was really low because their price was really high. Their potential was really low partly because their age was not near. I think their age was quite a bit lower, if I'm not mistaken. Okay, and it wasn't placed all that well. Questions about last week's assignment? I think I've gone through and corrected those, if I'm not mistaken, applied grades and everything. So, okay. So who do you think won this week? You think there's much doubt would be a good question. Well, let's go ahead and take a look. I think it's pretty anticlimactic this week. So, okay, here we go. The question's going to be are the other teams going to be able to catch? Two questions. Are the other teams going to be able to catch Chester, and will they or Chester be able to catch the computer teams? Scores, here we go. Ferris, Erie, Chester on the earnings per share. ROE, Ferris, Erie, Chester. Contribution margin, actually Baldwin did have the highest contribution margin, maybe because of their high price or high prices. I didn't look, I guess, in the other segments. I have to take a peek, but we know that I think they were still, even in round 3, still really high priced in the low end segment at least. Stock price, Ferris, Erie, Chester. Profits, Erie, Chester. Cash flow, Andrews actually had pretty good cash flow. Chester did have they got dinged for working capital. Every team but Ferris got dinged for working capital, however, so Ferris ended up having a good score of 95. Erie would have been second, but in terms of the student teams, Chester by quite a long shot. We saw a lot of emergency loans, didn't we? 3 of the 4 student teams, every team but Chester, I think, had an emergency loan, if I'm not mistaken. So I don't know if that was an overestimation of demand, overproduction. We'll take a look and see. So, yeah, let's go. ROS. Of course, ROS, when teams lost money, and 3, Andrews, Baldwin, and Digby all lost money, so their ROS is then obviously going to be negative. And it was. Their asset turnover, again, I don't get terribly excited about that, but it's kind of revealing that Chester had a lot better asset turnover. Okay. Look at Digby's, and their asset turnover is actually lower than Andrews. That is kind of interesting. Go down, if you guys have yours open, go down and scroll to the balance sheet. I think what you'll see is that Digby has a whole pot full of assets, okay, and thus it becomes more difficult for them to turn those assets over. Digby's a big company right now. We'll see that when we get down to the balance sheet. They're, I think, the biggest company in terms of total assets. It becomes difficult to turn those over. Okay, bigger is not always better is going to be maybe a theme here that we could start. Bigger can have lots of advantages. Don't get me wrong. A bigger Apple, has lots of advantages, right? Okay, but bigger is not always better, especially from an investor standpoint. Okay, especially from an investor standpoint. ROA. Again, we had losses, and so we got 3 out of the 4 teams that have a negative ROA. Lots of leverage, right? Looks like that's, even 2.1, 2.0, 2.1. That's reasonably high leverage, okay? Part of the problem, I think, for Andrews, Baldwin, and Digby, leverage was caused by, or what contributed to it would have been their emergency loans that they had. especially Baldwin and Digby. Sales, really low sales for Baldwin. Okay, really low. When you look at Ferris is up around 230 and they're about 70, so 3 times. That's pretty big discrepancy there. Chester was second best in sales, so Chester actually beat out Erie in terms of sales, but didn't quite catch them on profits. But we'll see why in a bit. We'll see why as we go down here a little bit. Earnings before interest and taxes, 13.5. Ferris got twice as much. That's pretty impressive. Okay, and then profits 3 times as much profits, really. Okay, twice as much. Ferris had twice as much as Erie. So, are we going to catch Ferris? Be interesting. We'll see. SG&A, huge number. So again, Baldwin's not getting efficiency out of its sales and promotions. Not getting efficiency at all. Nice high contribution margin, but not efficiency in this category. So, okay. My guess, and this is just one of those things. I'm coming down this far and I can make some guesses, and I like to do that, and then I'll go do the research. But my guess is, because of some of the other things we talked about, and that's that customer buying criteria, that maybe they're not matching up there as well as they could. Okay, you can be the highest priced item in the low end and still sell a decent amount of products. Maybe if you're doing some marketing and you meet some of the other criteria pretty well. Okay, but it's difficult to be the highest priced and be the highest priced by $2 or $3 or $4 versus by $1 or so, right? So the further away you get from your competitors, obviously the bigger the damage is going to be. So, a lot of us might spend an extra $1 to go buy a Dairy Queen Blizzard versus the McDonald's McFlurry or whatever, right? Because it's that much better. But we might not spend $3 more for something like that. Okay. Stock market. Okay, now I really don't think I have beat around the bush all that much. I thought I've been fairly direct, but I'll be even more direct. I don't even know if our distance team is listening to these recordings necessarily, but they again have sold more stock. Okay, now point blank, it's going to kill them. Okay, what's the difference here? You guys all have 2 million shares outstanding. They got 3.1 million, so they've got half again as many. What's that mean in terms of earnings per share? Okay, they have to earn half again as much as either any of you teams, okay, in order to win the earnings per share battle. It's more than half again as much, right? It's more than half again as much. So if you guys all made $10 million, they'd have to make about somewhere over $15 million just to compete on the earnings per share. Okay, huge, huge, huge factor. Okay, that also has implications for ROE, right? Because when they've sold stock, they've raised cash that goes to equity. Okay, so now all of a sudden their equity's higher, so your denominator is higher. Your numerator conceivably stays the same, right? So what happens to your ROE? It goes down, actually. Okay, it goes down. So by selling stock, they're shooting themselves in the foot. Okay, now I'll repeat again, and we're well past the first rounds here. We're going into round 4. Selling stock at the beginning, if you were really going to aggressively pursue some other things, if you were say a low end or a low cost provider, and you wanted to sell a bunch of stock at the front end and go buy all the automation you could possibly buy and borrow all the money you could possibly borrow to buy automation, might not be a bad plan. Okay, you might get a reasonable enough return on that investment over time that it would be okay. It would offset the sale of that stock. Right now, I honestly, it looks like they're just selling stock for the sake of selling stock. Okay. Now they did have an emergency loan, so they needed some cash, but that was because of some other things. It wasn't because of the lack thereof. It's that they produced way too much, and they ended up with $60 million, I think, in inventory or something like that. So huge dollar amount in inventory. So Digby, if you guys are listening to this, you might want to take a look at your financial planning that you got going on there. Stock market, like I said, we got some goofy stuff going on here, and 3 teams that are kind of Chester's holding its own. Baldwin, a little bit better. Ferris is doing okay. I'm hoping you guys will knock Ferris off. So, do got some borrowing going on. Digby's not shy about borrowing money either, so they're selling stock and borrowing money both, and we'll see that has made them a huge company. Okay, but I think we're going to see that they're the biggest company, but they've only got the third highest amount of sales. Ouch, right? Ouch. Inventory, yeah, they had a $45 million change in inventory, so that led to probably Digby's emergency loan. So what's their cost? What was their emergency loan? 50 million? Cash from emergency, 53 million. So what was their cost on that? Just roughly off the top of your head. If their interest rate was 10%, that'd be about 5 million. What's the other cost? Remember we did that just a round or two ago? Of course we had spring break in between, so. Remember what the fee was? Remember what Big Al's fee is? 7.5. 7.5%. So they paid another $3.5 million in cost. You know, that's right off the top of my head. It's a little more than that, probably closer to $4 million that they paid in a cost. So they had about $5.5 million, so about $9.5 million total dollars, okay, in interest and fees, for that emergency loan. Huge, okay. Andrew's not much, but Baldwin a pretty sizable chunk too. Right there, so would have been about 3 plus 2, so about $5 million. Again, off the top of my head, just kind of eyeballing it. Ferris is doing great, and they got $43 million, $42.5 million in cash. Chester, they're sitting on a decent amount of cash, so that's pretty good. Okay. Here's what I mean when I've said several times, plant and equipment. Digby has up to $207.4 million in plant and equipment, far and away the biggest, right? So they're the biggest company. Unfortunately, they're not generating the biggest, the biggest sales. Or I could say more, there's smaller companies that are far more efficient. Look, Ferris had the highest sales, and Ferris is, 60%, 65% the size of Digby, and yet they're still generating more sales. So Digby is not very efficiently or effectively generating sales based on their plant size. And I'm going to scroll down, I'll come back up. And here's part of the problem, okay? And maybe this comes home in spades a little bit when we talk about it. I've often said, having a lot of capacity, and you can see here, Digby's production was just barely, their overall production was just barely in excess of their first shift capacity. So they have tons and tons and tons of excess capacity. I would assume, because they have far more capacity than any other team, I would assume that they've been investing money in capacity, okay? And so they've become a huge company that has all kinds of capacity, and yet they're not generating the sales that they need in order to be really profitable, or profitable at all for that matter, okay? We saw the inventory was a problem for a couple of those teams. Plant improvements, wow, look at Erie and Ferris. They're still going to town. $45 million in plant improvements. $32 million for Digby, so they've invested some more in plant improvements. Where that's going to, I'm not 100% sure. Might want to find out. Chester invested $20 million in plant improvements, so that's fairly impressive. Sale of common stock. Again, you see Erie and Ferris. And you guys might argue, okay, well, Erie and Ferris are selling stock and they're beating us right now. They are, but it's one of the reasons I say I think you guys will be beating them by the end of the game. I would hope so. Cash issued from long-term debt, great. They're borrowing money too. Retired the current debt. Cash from current debt borrowing. So while Chester ends up with some cash down here, $20 million, they borrowed $25 million. So they spent some money that they didn't have, but they went ahead and borrowed on a short-term basis. Okay, I think we grow up with this, and it's rightfully so in our personal finances. Okay, I would absolutely, if I was teaching a personal finance class, I'd completely flop and I would say, stay away from current debts. For God's sake, don't borrow money like that. Don't run up your credit cards. Don't do stupid things like that, right? Okay. I'm going to flop when I get to business and say when there's excellent investment opportunities, okay, or if even in a personal case, if there's investment opportunities, what happens in a personal case is most people borrow money in the short term to buy depreciable assets that aren't going to create any income or anything for them. So they're borrowing money to buy cars, they're borrowing money to buy clothes, they're borrowing money to buy stupid things that will never generate any money, right? Okay. On the other hand, in the business sense, if we're borrowing money to buy things that are going to generate cash, generate profits, generate those types of things, whole different story, right? Whole different story. Okay, would be on the personal side too. If you were borrowing money on the short term because you want to go buy some Berkshire Hathaway stock or something, that might not be such a bad idea. Okay, might be a little speculative, but I don't mind a little speculative sometimes. Okay. So again, size of the company just huge. Look at their total fixed assets, 135 million. Erie's kind of next closest. Total assets 217. That's why they had such a low, asset turnover. Again, I don't spend a lot of time looking at the asset turnover ratio, but it doesn't hurt to glance at it. I guess it gives you an idea what's going on down here. Maybe a reason to come down and do some more investigating. Their total equity isn't all that big. Okay, a lot of that's because of that emergency loan that they had, right? Yeah, they created a lot of inventory, they paid a lot of interest, they did a lot of things, and so their equity's not that big, but the total assets are huge. Sales, again, we looked at those up above. I thought I said Digby was third. Digby was fourth in total sales, right? So they got by far the biggest company, and yet they're only fourth in terms of total sales. Okay. Variable costs. I don't look at the absolute numbers that much. Depreciation, we would expect Digby would have the most, and they do. SG&A, pretty efficient. Erie had to be really efficient. To generate the sales they did and only spend $13 million, that's pretty efficient in terms of SG&A. So their SG&A to sales should have been relatively low, right? But what do we know about Erie? What's their strategy? For Erie, yeah. What's their strategy?
They're low end, aren't they?
Low end niche, right? Low cost, low end. Okay, so they're trying to keep their costs down. They're going to really fight to meet the customer buying criteria and maybe not spend a lot of money on sales and promotions. Okay, and they're also in the low end where it's perhaps, and if they're only in two segments too, right? So you don't have to spend maybe quite as much money if you're only in those two segments, right? Okay, so that's a big deal. That's part of their low cost strategy. Okay, so we got other fees, write-offs, TQM, 6.5. Ooh, look at that. Chester spent $17 million. Remember up above I was saying Chester had the most sales, and they had a pretty good contribution margin and decent SG&A, and yet Erie passed them in terms of profit. Erie only had $4.8 million here in terms of TQM. Chester $17 million, and that's a cash expense. Okay. So they went from Chester having far more profit to Erie passing them by a little bit. Okay, we'll see what the impact of that was, and in fact, you're probably going to have a couple questions that relate to that. EBIT, earnings before interest and taxes. Interest, we would expect Digby had a huge number. Look at that, $21 million in interest, just huge. Chester the lowest. 7.3, even though they had that pretty big short-term loan, right? But of course, they didn't have an emergency loan like the other student teams. Again, with the exception of Erie and Ferris, just all kinds of capacity, right? I would say as an industry, there's just excess capacity. It's just sitting there. Okay, lots and lots and lots of capacity. Andrews looks like they're kind of focusing on maybe a life cycle low. I'm not 100% sure, but they've got a low, a traditional, and a high-end product. You would expect if they were doing the life cycle that they'd be introducing a product in the high end, letting products drift back. So I don't know yet. We'll have to take a look and see. We also see, this is kind of interesting, they still got a size product here, but looks like Baldwin's kind of in the low and traditional side. Chester, pretty broad, it looks like still. We got some investments going on here too. So some of these plant improvements are really starting to show up over here, you know, in automation, which is going to really drive down labor costs, should drive down labor costs big time. A little more subtle probably here, a little more subtle here, but they've already introduced a new high-end product, right? Okay, which would have contributed to their capacity. One of the reasons they have spent money, one of the reasons they have a bigger, okay, but so is Ferris. Remember, Ferris was quite a bit smaller, and Ferris has introduced another product, and Ferris is still able to generate quite a bit more in sales. So Erie investing a lot of money in automation, as we might expect in the low end there, low end traditional ends. Boy, look at Erie dominate the traditional. Wow. God, that's got to be, close to half. They had the potential for close to half of the market. Huge. All right, so you guys are kind of letting them get away with that particular market for whatever reason. Now, they do have 3 products in that market. That's part of the reason, right? They don't have the number 1 product. The number 1 product was Chester, but they have 2, 3, and 4. Okay, so big deal there. Low end Erie also dominates there. Ferris, surprisingly, had the next best potential, and again, the rest of you are kind of giving them some of the potential. Again, bead or Baldwin product. In fact, the high end, the top range price is $23.50, so they were even 50 cents over the customer expectation there, and probably it looks like they benefited again a little bit because some of the other teams didn't make quite enough. The benefit there wasn't that big, but their potential was really low. 99% sure that low potential is due to the price. I'm not sure where they're sitting otherwise. Coordinates don't look that far off. Age isn't that bad really, because look, here's a product that sold quite a bit more. A couple of them that sold quite a bit more, that had much lower ages. That their ages were a lot further away from the optimum, and yet they sold a lot more. So. High end, ooh, look at Ferris dominate there. Wowzer. Chester took advantage a little bit. They benefited because Ferris left a little bit on the table. I know Chester had a little problem. If we look at this, look at the revision dates. Okay, so they had a little bit of a problem. It may be an issue next round too, because their December customer survey is just 12 going into the next year. The revision date is just at the start of the year. They'd screwed up the year before and extended their production out, or their R&D out a little bit too far. Okay. Fist and Fox, on the other hand, they changed right at the end of the year. So right now the December customer survey is looking really good for them, as it is down here for Ding. But Ding was a brand new product, remember, right? Brand new product, and so people are still pretty excited about that. Fist or Fox, one of those was a brand new product too. I think it was Fox. Performance, ooh, here we got a good competition going on. We only got 3 teams competing. Okay, 3 teams competing, so that's kind of interesting. Boy, 20% growth rate, 3 teams competing, pretty interesting. So, size segment, 4 teams kind of competing. Digby a little bit, not a lot, but the other 3 teams, Baldwin's competing in the size. Okay, interesting that they would. Map's kind of interesting. Maybe that's why bead was priced so weird, because Baldwin's got 2 new products being introduced in the low end.
No, I don't know why that's up there. Is it because aren't those from our? I don't know. They're from our high end. Can we go ahead, we can go ahead and just sell our last round?
Oh, I think you did. Yeah, so they'll disappear.
Yeah.
I'm going to scroll all the way up. I'm sorry. Bid and bold and bite was a new one, though, right?
Yeah, our performance and size coordinates, I don't know if they didn't save or
Okay.
someone changed it, but that was supposed to be like at the highest point for our size segment.
So bid and bold are going to go away, but you got ball and bat.
Yeah, I don't know where those are coming
It's got to be some new products
from. I
that you've established the coordinates for, I'm thinking, but you haven't bought capacity for yet or anything, so it's not showing up above. Okay. HR, seeing some investment going on there. Baldwin actually spending the most. Baldwin had high contribution margin, remember? So part of that was because of their prices, we know, but part of that might be that they're doing some stuff down here to cut their labor costs too. So TQM, look at that. We knew this from above. Look at that. Chester spent almost as much. Do the math quickly in my head. 12, 17. Not quite, but almost as much as the other 5 teams put together in TQM. And Chester was still victorious for the student teams. If I were the rest of you guys, I'd be really, really scared, okay? Because when I look at these numbers down here now, I see material cost savings of 5.25%, labor cost savings of 7%, reduction R&D cycle time, 28%. That's huge. So a quarter, okay, more than a quarter. Admin costs, you guys need to go look at your admin costs to know what that means. Your admin costs aren't all that much, a few $1,000,000 maybe. So they're gonna save a couple $100,000 or something maybe on their admin costs. But an increase also in demand of 6%. And relative to the other teams, that's pretty strong, right? Really strong. When you're selling 150, they were selling a little more than that. You know, that's 9 million, 10 million so in sales, something like that maybe they're generating because of that increased demand. So those are some huge numbers. And again, those numbers will stay there, okay, or get better if they decide to invest any more money. They can't take it away now, okay? These numbers can't get any worse than this. So that's going to be every round for the rest of the game, and you can't take it away, okay? Questions about the Capstone Courier before I jump into next week's assignment? Questions about the game and how it's going along or anything like that? Everybody's at least now got a comfort level with the game and you kind of understand what's going on and all that other good stuff. It's not so bad anymore. You don't hate it anymore. You don't hate me for making you do it and all those other things, right? It's good. I'm not feeling the love yet or anything, you know, but. Okay. Let's take a look at the upcoming assignment. First question is going to be, good one to ask because Chester doesn't have to do the assignment, so I'll ask a question about Chester. How much did Chester save in variable costs as a result of its investments in TQM? It's an imprecise calculation. Okay, this is an imprecise calculation. Chester themselves might be able, they could probably get into their annual report and do a fairly precise calculation of this, but the rest of you don't have enough information to do a real precise calculation, okay? But you can make some assumptions, right? You can make some assumptions that should get you pretty close. It should get you a ballpark figure within, you know, let's say within $1 million, say, okay? And so show me your assumptions is what I'm saying. So, you know, I could say total variable costs times, you know, something, whatever the case may be. I'm trying not to give away a whole bunch. I want you guys to think about it a little bit and how you might calculate that, okay? Because and you just go to the TQM summary. That tells you what they're saving, right? Okay, on their labor and whatnot. But you're gonna have to make some assumptions there. So, okay. Now, question 2: what would Erie's ROE have been if it had a cash position of exactly Zero. So Erie had quite a bit of cash. I think 20 million, something like that. Okay. So let's just say let's say they spent that. I'm sorry. Let's say they paid all that cash out in a dividend. That would be a good example of what they could have done with the cash. Okay. Then I want you to really just recalculate what their ROE would have been. Is that going to change their net income if they pay all that out in a dividend? It's not going to have one bit of impact on their income. What's it going to affect? There's only two components, remember, to ROE. What are they? What is ROE? Return on equity. What's return on anything? Net income divided by the anything, right? So in this case, it's net income divided by equity. Paying out $20 million in dividends has zero effect, zero on net income. So what's it going to affect? That's what you need to know to calculate that. Uh-oh. I gave away that answer. Shoot. So I gave you guys the answer to number 3 already, so I'm not going to say any more about it. Why is Sid's December customer survey number so low? Gosh, can't believe I did that. Four, Erie invested about $45 million in plant improvements. What is the immediate effect on profit? This can be shown in numbers, but numbers aren't not absolutely required. So again, there's some calculations that you could do, and that's fine. You don't necessarily need to do that. I just want you to think about what happens when you spend money on plant improvements. Okay, the alternative often might be something like TQM. Okay, what I mean by that is that plant improvements are not an expense, right? Ooh, seems like they should be, doesn't it? But plant improvements are not an expense. They're an exchange of cash for another asset, right? Okay, but it does have an impact on, it does have some impact on profit, and that's what I'm asking you guys to figure out for me and kind of explain it. You might give me a rough idea, you know, of a number. You kind of do it in your head maybe a little bit. One thing, and it might be something that we could expect a little bit in the future, Mikhail and I were talking about it yesterday a little bit. Okay, I'm going to come back down here, and Chester spent $17 million in TQM. Okay, TQM is an expense. Okay, that's an outright expense. You get to deduct that on your tax return. Okay, so now my question to you is, okay, what is Chester's after-tax impact of that $17 million investment expense, I should say? What's the after-tax implications of that? Everybody's looking at me like they're really, really stumped. I'm going to open up Excel and maybe do a little something in Excel. This is going to be an oversimplification, okay? But let's say they made $17 million, okay, in gross profit, right? So they got $17 million in gross profit, but then they spend or they invest in TQM $17 million. So what's its net income? Zero. Okay, so what's its taxes? Zero, right? They didn't make any money, so they got zero taxes. Okay. Let's say they made that same gross profit of 17 million, but they didn't spend anything on TQM. What's their net income? 17 million. Okay. Leaving out probably some other variables and stuff that might be in there, right? What's its taxes? What did we say our tax bracket was in this game? 30%? Is it 35? Okay, 30 or 35, somewhere's around there. So we'll say 35. That's fine. Sure, make the math a little bit more difficult. So that would be 5.1 plus 635,000. Yeah, 5.1. So 5.735 million in taxes, right? So they would still show a profit here, you know, an after-tax profit of whatever that is. Okay. So the after-tax impact of that investment, they invested $17 million, but if I compare these two, what I can tell you is that their real cost on that was $11,265,000. That's the way to look at that, right? Because if they wouldn't have spent that, they'd have sent $5.7 million to Uncle Sam, right? They just sent a ton of money. They'd have written a big check to Uncle Sam. They didn't have to write that check because they had a $17 million expense. Now, I'm missing all kinds of things in a calculation. You know, if I were a real finance guy, I'd really have sharpened my pencil up, because what I don't know then in this calculation, this is too basic, because what I don't know is their investment here also would have saved them a ton of money on labor and materials, would have saved them some money on administrative costs, and would have saved them some R&D cycle time, so it's going to save them some R&D money. Okay, and it actually would have increased their sales, and so it would have increased their gross profits. So this is really just a minimum savings that they had. Okay, right? They then, if you started adding in all the other things that they benefited from, okay, I'm not going to tell you that they got full cost recovery in 1 year. They did not, nor will you in 1 year. You will not get full cost recovery in a year on an investment in TQM. But we'll see how the long-term effect might be. Mikkel's just getting ticked at me because I'm giving away all their secrets. Okay, any questions? No questions? Okay, I will try to get your spreadsheet and your assignment sent out, due on Tuesday when we have our next round of decisions due. So, by the way, announcement, I forgot to announce, the Skylights play Friday at, I think it's around 1:15 is what I've heard. Have you guys heard any different? So I'm pretty sure they're going to stream it again down at the sub. So if you're interested in going and watching and cheering on the Skylights a little bit, go do that. So we might have, from our conference, if everything works out today, we might have 4 of the 16 teams in the Sweet 16. And Carroll and Westminster have to play yet today. So that would be pretty impressive for our conference. So. Okay, sounds good. See you guys on Monday.